And I am excited about today. I'm really excited to get into this budgeting and planning process with you because, as always, Bonnie, you are one of my favorite people on the planet, let alone favorite accountants, which is saying a lot because we have a lot of accountants that are that I know very well. And I'm just really looking forward to your insight. I was actually just on a Zoom call with a client this morning who said, okay, we really need your help in just running the entire budgeting planning process. And they have a CFO and a controller, but they're just overwhelmed with workload. And so I really think that's a big issue. Staffing is a big issue. We've seen so much turnover in accounting departments this year that's become a big issue. And the other thing that we're seeing is this wild volatility in the stock market, in the bond market, in interest rates, and in raw material prices, and in, frankly, labor costs. I just read an article in the Wall Street Journal yesterday that said that lumber costs had gone from, in 2019, $410 per linear foot, all the way up to $1,600 a linear foot, back down to $600 a linear foot, back up to $1,300 a linear foot, and now we're trading at under $400 a linear foot. And there was a mill in Canada in this article that said, we don't even make money unless we sell it at greater than $450 a linear foot. What are we doing, right? I mean, it's just this extremely volatile market. And when you think about interest rates, you think about, mortgages that people are paying. Mortgage rates are now up in the 6.5% range for a 30-year fixed mortgage. That is going to absolutely crash the real estate world. Places like Home Depot not going to sell stuff, contractors, construction. So when we're looking at planning here, I think it's so important that we think about all the stuff that's going on in the macro environment. So really excited to dive into this with you and start to understand what we can do to protect ourselves and really get predictable results during this kind of volatile time. I want to remind everybody, if you've got any questions, please make sure you throw them in the chat to either Bonnie or myself. We will make sure we get to them. Sometimes we can get to them while we're going, but we will always get to them at the end and make sure that we answer all of your questions and stay till the very end of questioning. So, all right, Bonnie, let's dive into this here and start to talk about kind of what it is that we can do in this. And so let's just start with, what does the year-end, what does the planning process look like for you and your clients?
Yeah, absolutely. This is a great question, and I totally hear you on volatility in the market. As you know, Matt, I'm planning my wedding right now, and I did some research. I was just meeting with vendors, and the cost of a wedding before and after sort of the pandemic as the main time frame has gone up 33%. So, I'm trying
you're feeling this personally.
Yes, I'm feeling it personally. I just bought my car out of my lease, which is, it's a unique time where that makes sense to do. And
sure.
Best rate I could get is 6%, which, 6 months ago, that would have been a lot less. So
yeah, like 2%. It's crazy.
Yeah. So definitely feeling it personally and in business. I'm really excited that we're talking about the planning process because we are just about to embark on that. So in terms of what that looks like and the timeline, best time to start planning for the following year is going to be in Q4. So when we're looking out at 2023, we are getting into Q4 of 2022. So now is really the time to start. What I like to think about is sort of where we begin. A lot of people think with the budgeting process, think purely about the financial model. So building out our income statement, but we really need to take a step back and think strategically and set goals. So that kind of first phase is going to really be this goal setting, strategic planning, really getting your high level people in the organization together to say, okay, what are we going to be doing next year? Thinking about the economy. Are we going to open a new line of business? What's our customer retention going to be looking like? What investments are we going to be making? Where do we want to go? And sort of also layering that into your longer term, plan. So that's really, I just wanted to make that point of that's really where it should start, as opposed to just, okay, let's plan out what are our revenue and expenses going to be next year.
Yeah, I feel a lot of times people just say, okay, well, what did we do last year? All right, put that in an Excel spreadsheet, and then let's take a look at it. And maybe we add 15% to revenue, and maybe we increase these other things. So what you're saying is really start with, where is the vision for the organization going? and make sure you understand what that 5-year, 10-year looks like, and then back it back down. I know at TGG we're going through this, and we also do an evaluation of our core values and our mission. Can you tell me about who should be involved in this process if we're expanding it to more than just the financials?
Yeah, that's a great question. So there's going to be a lot of people involved. Really that kind of first part of the process that I was talking about, where you mentioned where you're really looking at core values, mission, vision, strategy, goal setting. That's going to be sort of your top level people. So you might call this your leadership team. You might call this your executive team. The CFO is really going to be leading this entire process. So the CFO is going to be part of that as well. So you might think COO, CFO, CEO, maybe your head of business development. Really, you want sort of your key leaders there. That's where you're going to be really thinking like, are we aligned on our core values, our mission, our vision, right? Kind of resetting on that and thinking strategically.
Yeah.
All of that should be kind of done by October 15th. So I'm going to talk timelines a little bit in here too, but you want to have a target to really have those meetings happening by October 15th, so that then you can transition into the next phase, which is going to be when sort of the CFO is bridging between these meetings into the accounting department and some of the other departments. So you have sort of this big picture, where are we going? What are our goals meeting? And then, around October 15th, that's when CFO is going to lead meetings with the various department heads. And what we really want to do is have departments really own their own budgets. So you meet with head of technology, head of HR, head of sales, and kind of talk to them about, what do you think you're going to need to achieve our goals? What do you need to hire somebody else?
Yeah, so if we're starting on October 15th, or starting in early October to get kind of the team aligned on vision and values, what's happening between October 15th and November 15th is what you're saying is that we should be getting departmental budgets back from people on what they think they need to spend in the upcoming year.
Yeah.
And I guess revenue forecasts as well from sales.
Yes.
Okay.
Yeah. And so that's when, so October 15th, really what we want to have CFO and controller sort of leading on the revenue side. And that's going to be, to your point, involving the sales department. I think we'll talk a little bit later about sort of the best way to budget in terms of top down, bottom up.
Okay.
But so that's where sales department's going to be really involved on the revenue side. And you're going to have your controller, who's going to be, the controller's key role is to be in charge of that Excel model. Okay. So the controller is really going to own your budget workbook, where you're going to have your income statement, your balance sheet forecasted out. So it's important that they're very key in the process in all the meetings with the department heads, and also providing department heads with information that's going to be helpful for them. So while we don't want to base the current year budget on what we spent last year, it's definitely important to let the department heads know, hey, here's the memberships or subscriptions that your department was part of. This is the technology that you guys invested in last year. So they kind of understand what the actual numbers were and what where their money was being spent.
So the accounting department still has to give them kind of a baseline of,
yes,
here's what happened last year. But obviously, how do you get the message down to those department heads that the business plan is still the same? Like, this is where we're going. We're still doing the same kind of things. How do you get that down in this process?
That's such a good question. Actually, one of my clients were, what we're going to be doing is sort of after these higher level executive meetings, there's going to be a budget kickoff meeting of like, yay, it's budget season, and all the department heads will be there. And that's really where we're going to sort of realign on what the plan is. And that's going to be communicated by the CEO in this case. So it's sort of this.
So once you get the board together, or the partners or the executive team or whatever it is, and you come up with that strategic vision for the company, that's when they got to do that before October 15th. I'm just trying to get the dates right. And then that October 15th to how long is this period where you're giving the information down to the department heads and trying to get information back from them? Yeah,
that's great. Next point. So a good target is going to be to give about 4 weeks for that whole process. So that's where really the controllers are going to be meeting with the department heads to go over sort of what they came up with. Again, looking at that revenue side. And then a good target is by November 15th to sort of have the first draft of that financial model built. because we know that it's not going to be one and done, right? This is an
Right.
iterative process where when that's done, we go back, meet with the executive team and see, okay, where do we need to trim? Where do we want to add? How is this actually looking now that we've laid out what the sort of financial execution of this is going to look like?
Okay, so, all right, so we start with this whole kind of broad, big picture. We're here at October 15th. We give the department heads the background, but we tell them what the strategy is. That's the CEO that needs to do this.
Yes.
What I've heard you say is the CFO is orchestrating this entire budgeting and planning process, and the controller is really the one who's got the kind of, for lack of a better term, hand on the wheel, right? And driving the actual modeling and all the rest of that stuff. We got our budget first draft by November 15th. What's the next sort of step in that process?
Yeah, so a good target date to have sort of everything finalized is going to be December 15th. So I'm doing this in monthly increments, and the 15th, I think it works really well in terms of milestones. So December 15th is really a good date to say, okay, we're going to be done. We're going to sign off on the budget, and then that's going to be communicated out to the rest of the company, right? That's before the holidays, before everybody starts taking time off. So it gives you a good amount of time to communicate. Right. So, I guess I should have started this by saying the way we sort of came up with this and why we recommend this is we started with sort of our final goal and worked our way backwards of what milestones we need to hit. Just like if you're traveling, I was recently traveling, my flight leaves at X time. What time do I need to leave my house? And I go through all those little steps to get back, right?
Yeah. That makes sense to me. I also really like how you've broken it down because I always love this one throat to choke philosophy, which sounds a little gruesome, but it's really have one source of accountability for one thing, right? So in this case, the controller owns the model. If there's something broken in the Excel formulas, and that's the controller. The CFO owns the process. If we're not following the process and getting things done on time, the CFO owns that. If we don't get communication around the vision and strategy, the CEO owns that. Right. And so I kind of like how if we don't get budgets back from the department heads, if we're budgeting by department now, which is pretty unique. A lot of companies I watch do not budget by department. If you're doing that, then you can go to the department heads and say, in 2023, wait a minute, you told me in February we were going to spend this. Here's what our actual spending was. Or you said sales were going to be this, but here's what it actually was. So I really like that one throat to choke kind of a concept. Do you have any examples of where that concept of budgeting by department has worked well for you and your clients?
Yeah, I have a client where this has worked really well. And part of what's made this work well is that last year was the first year that we budgeted by department. We were able to really create accountability within the organization and the departments by exactly what you're saying, looking at budget to actual. We made sure to have our controllers set the model up such that it was easy to sort of roll it forward, drop in actuals by department, and have a report card, if you will, for that department to say, here's where we thought we were going to be, here's where we are. And something else that we did with this particular client is that we've set up the accounting system to report by class. We report the income statement and by class. So what this means is, if I get an expense for a vendor that's a subscription that my, let's say my HR department is using, we're going to code that within our accounting system within the HR class so that it's going to show up and I can easily use my accounting system, run an income statement by class, and then I can kind of see where each department is. So I think that's really critical for your accounting team to facilitate and set up in order for this to be efficient and successful.
Yeah, that's interesting. Ultimately, it's trying to increase accountability. And what I get worried about when we have all this economic uncertainty is making sure that I very firmly believe that this economic uncertainty is going to create a lot of opportunity, not just fear, right? And if we can execute, if everybody on this Zoom can execute effectively, I think we can actually gain market share, improve our overall our talent pool of our employees. But we've got to watch it pretty quick, pretty frequently. Mm-hmm. So there's two terms that get tossed around all the time: budgeting and forecasting, right? And I don't think that a lot of people understand the difference between budgeting and forecasting. So here at TGG, how do we really define the difference between budgeting and forecasting?
Yeah, so what we've been talking about sort of so far in this conversation is the budget.
Sure.
So the budget is something that everything we just talked about in Q4, you're setting it up. It is static. So that is your budget for next year. We do not change that. That is sort of, I've got one client that calls it their Bible. So you pick whatever you want to call it, right?
Yep.
So we've got that set up for the next year, and then we're going to report against it. So again, like I said, having that your model set up so that every month, every quarter, right, however you want to slice it up, you're able to compare your budget versus actual. So that's the budget. Biggest thing is that that is unchanged once it's set. Now, you were talking about, Matt, how do we manage uncertainty, right? We know that next year and right now things are volatile, things are changing, and we have to pivot. And we know that at the end of Q1 of next year, we're going to have more information than we did in Q4. So how do we factor that into our projection for what's going to happen with our business? And that's where the forecast comes in. So the forecast is dynamic. Biggest difference, right? Budget is set once a year. The forecast is dynamic, and we're going to modify and reforecast every quarter. So to kind of go along with the process that we were just talking about, we've got our budget set by December 15th. We go into Q1, January, February, March, we report our budget versus actual. After March is closed, so by April 15th, at that point, accounting and finance is going to reforecast. And again, meeting with department heads as necessary, meeting with the executive team, and they're going to reforecast what we recommend 4 quarters out. So at the end of Q1, you'll be forecasting out to the end of Q1 in 2024 in this case. And that's where you can really start to embed in there any changes that have happened to your business specifically, any changes in the economy, so that you've got a sort of more relevant view of where you're heading.
Sure. That makes sense. That makes sense. All right, we've got a bunch of questions coming in here. So let me get to a couple of them here. And I want to remind everybody, I don't think I did this at the beginning. Our Bonfire Chats, we, for all of the attendees to our Bonfire Chats, we offer a 30-minute consultation with one of our top CFOs to look into the books, talk about things, free consultation just to see kind of what's going on in the company and see how we can help and maybe answer some of the questions. But here's a good one that just came out. And I'm going to frame it a little bit differently. We've talked about kind of this budgeting versus forecasting. We've talked about the calendar on how to this, but what are some common mistakes? What are some things that you see people do that are just do not do this? What the question was is what's a don't? What's a don't in the budgeting process?
Yeah. Do you want just one? You want me to? I got a bunch.
Well, let's start with maybe we can do like top 5. Be like
Yeah.
or I don't know, whatever. You tell me.
Yeah, certainly.
Give me your top 1 first. Let's start there.
Yeah. So I would say my top 1 is don't set an unrealistic budget. And there's kind of 2 sides to this. So we don't want to, and I'm going to kind of link this to something else. You don't want to set some arbitrary sales goal. We don't want to say, and we kind of said this before, we don't want to say, oh, we're going to increase revenue next year by 25%. That's just what we feel like we can do. That, and especially if that's coming from the CEO and that's not agreed upon by the sales team and the people that are actually executing the sales. Sure. Don't do that. That is going to set your people up to fail and potentially decrease morale. And it's same on the expense side. If you budget way too lean, then what's going to happen is if you end up, that's something that's unrealistic, then everybody's just going to be disappointed.
Yeah.
So
sorry, go ahead. I think what I was going to say is it's interesting that you talk about it because you're really talking about two different things that are very tied together.
Exactly. Yeah.
I preach about this a lot, and I use the word preach because I think it's important. A lot of people will talk about setting. Have you ever heard that term BHAG, Bonnie? Big, hairy, audacious goal.
Oh, I think so.
Yeah, it's been widely circulated over the last 10, 15 years that you should set a BHAG, a stretch goal, really stretch out there. And I think that's fine to do. I'm personally not a big fan of it because I don't like losing. And I feel like if I've got this super stretch goal and then I don't hit it, I'm losing, as opposed to setting realistic goals where I have realistic expectations that they're hard, it's difficult, but I can go execute on it. So I think part of it is goal setting and doing that. And what I think I hear you saying is, even if you want to set a stretch goal somewhere out there, don't put it in your budget. That's not a place for a budgeting expectation on your base budget, right? And that's what I hear you saying. The other thing that I hear you saying is on sales, don't just set an arbitrary number, but how do we link? This is something that just popped into my head as you were saying that. The business owner says, listen, I want to double the size of my company in the next 3 years. Well, that's about a 25% annualized increase in revenue. How do you triangulate to get to that end goal? That's the vision. We've all confirmed that. How do we get there and still get the buy-in from everybody else so we avoid this big, massive, don't just arbitrarily put a sales number out there?
Yeah. So what I'd recommend is that you take a top-down approach to budgeting for your sales for the next year. And what we mean by that is, right, let me say what that isn't, right? Bottom up is where you set all your expenses and then you kind of base that off last year. And then you look and you say, what revenue do I need to bring in based on these expenses in order to get the profitability that I want, right? So the top down, what we really want to focus on is a couple of items is customer retention and new business, right? Those are kind of our two components to sales. And on the new business side, we want to understand our whole sales funnel and start with, where do leads come in? What's our lead generation metric? And what's the volume of that going to be based on our current personnel or whatever marketing we're investing in, right? So if we know our number of leads, and then there's a couple other steps on the way, and we know our close ratio based on history, we can predict what's our new business going to be coming in. And similar on customer retention is, what is our churn rate been in the past? How many customers drop off, right? These are actual assumptions that can be built into a revenue projection that are going to support that number and make people feel better. So the sales team can actually grasp how they're going to execute that, right? Sales and marketing. And I will say too, that taking that approach is also going to be very helpful in terms of valuation, because if you're looking to exit, or if you're looking to take out more financing, that forecast or that budget is going to be really important to understand. And I've seen before where if we say we are going to increase revenue by 25% and that's not supported by actual assumptions, it's really hard to get a bank or a potential buyer to subscribe to that story.
Sure. No, I think it's a good point. So what I hear you saying again is like, let's make sure that we don't just set an arbitrary number. We don't just use the expenses to try to figure out a revenue figure. We don't just slap on a percentage of growth, but what we in fact do is dive into the base marketing metric and say, how much more of this are we going to do? And what's that going to lead to? And then what customers are we going to retain and sell more to? And so one of the things that I've been, I heard this coined, I can't remember what book it's from that I read about 2 years ago, but I loved it. And so this isn't my thing, but it was called, you've got this sales funnel and a customer retention funnel. So on the one hand, you have sales funnel with brand new people, but what are we doing on the customer retention funnel? Because Bonnie, you made a really interesting point about the other real place where you get revenue is by retaining customers or getting the same repeat customers if you don't have kind of a retention-based model. So that's great on the revenue side. That really helps because then you've got actually even more accountability, don't you? Because you've got accountability to marketing to have that metric, accountability across all the functions, accountability for your sales support team and your customer service team to make sure that we've got retention. But what if I'm looking at, I'm a manufacturing firm or I'm a distribution firm and I'm looking at increasing costs and expenses out there for new facilities or new machines, things like that. What's kind of another thing that you think either is a to do or a not to do during that process?
Yeah, so you're touching on something that's really important, and I sort of alluded to is do include a balance sheet forecast budget.
Yeah,
we'll say budget.
I
use these all the time.
No, every time I take a look at a business plan and look at a budget, I almost never see a balance sheet forecasted out with it. which could be a really big problem because you could run out of cash. I mean, at a very simple level.
Yes, you're spot on. And that's really why the balance sheet forecast is so important, is for cash flow planning and to get a full picture of the financial health of the business, right? So you and I talk all the time, Matt, that cash is king, but profits generate cash. So that's a lot of times why we only focus on profitability. So let's get that income statement budget nailed down, ensure we're profitable. But we have to understand elements of the balance sheet that are also going to be impacting our cash cycle and our cash flow. So a couple of those in terms of the cash flow is what you just talked about, are investments in long-term assets. So long-term assets, whether that's going to be physical machinery or whether that's something intangible like software development or your website, that's all going to require cash flow, but that's not going to show up in your income statement plan until it starts depreciating over time, right? So we have to include that to see what's our cash outlay. And we also might decide maybe we need a new machine. And at this point, kind of the way we're looking at the budget, we want to finance that. So now we've financed machinery and now we've got a monthly payment on that loan, right? And same with really any other loans. So those are a couple balance sheet things that have to do with actual cash coming in and out that is not really hitting the income statement. And then the other thing to think about is what I was talking about, the cash cycle, right? So we know that accrual-based accounting is the only accounting. So that means that the way we're recording on the income statement, we're looking at our business is we're looking at when transactions are actually occurring rather than when cash is exchanged. And so what that does is we end up having accounts receivable and accounts payable are the best, I feel like the best example of that. So
Sure.
if you're a business owner listening, right, if you sell, let's say you have an incredible month, you have $2 million of sales. If you're not collecting that for 90 days, but you're paying your vendors in 60, you're going to have a big problem. And the income statement's not going to show you that on its own.
No, it's fascinating that you said that because I was just talking yesterday with a client, and she's in a business where she thinks it's going to be very advantageous for her to buy competitors because she thinks the baby boom generation is wanting to retire, and she just thinks there's a lot of opportunity there. And I said, that's really interesting because right now, I think that's a great opportunity. And if you think about all the volatility in the marketplace, it's a huge opportunity for people to buy businesses that might be, struggling in this economy or going to end up struggling and wanting to get out quick. I think the interesting thing that I heard in between that is she's got a lot of inventory. And they're only turning their inventory every four times every year. And what I went through was a scenario. I said, well, if you turn your inventory 8 times a year, so just 50% better than 4 times a year, do a little bit better with inventory management, what you're going to see is an profitability increase of 4 to 5%. And with that came a decrease in warehousing needs. All of a sudden, you need half as much space to carry the same stuff. That means half as much rent. And so all of a sudden, we're thinking, what's the balance sheet forecast going to look like to buy these businesses? And that sounds great, but you got to know what the cash is going to do and how that's going to generate increased profits so you actually get a rate of return on those. And that, I loved the strategy, but I thought that was a really interesting way that strategy comes into budgeting for both the income statement and the balance sheet.
Yeah, absolutely. And I think something else that's important, and we talked about accountability, Matt, is some of these things that what you just talked about, inventory turns, what I was talking about, basically your accounts receivable and what we call days sales outstanding, how long it takes to collect. We can set targets surrounding that, and we can report against it throughout the year, right? So to say, if we want we want inventory to turn 8 times a year, great. Where are we at the end of each month? And then the one throat to choke, who's kind of managing that process, who's responsible, and who can we hold accountable for that?
I love that. Just like we talk about in our accounting departments, we want to set an AR collections days, right? And we want to be under that and constantly improving. And so I think you can set that at every department and at every level, but it does impact cash, which then does impact profitability. We had an interesting comment here. It's a bit of a question / comment. So I'm going to throw it out there for you, Bonnie. It says that you want to review, and then in brackets, third-party audit of your operating expenses. So have you seen an audit, basically a third-party audit of your operating expenses? Because this person says this can easily improve revenue. It improves cash flow, and then I think their point, which I would completely agree with, is every dollar reduced in cost and expense is a dollar of new profit, drops straight to the bottom line. So, and contrarily, a dollar of new sales is not a dollar of new profit. So,
Right.
what have you seen with your team internally in terms of a review of operating expenses? Because I really think this is an interesting concept of getting out there and getting having the discipline of at least once a year doing a full review of operating expenses. What have you seen as best practices with this?
Yeah, you're spot on. I mean, I think the best practice had always been really once a year, look at your operating expenses. Once the pandemic happened, my clients, we started looking at that quarterly because we were really looking at what we can trim down. But yeah, typically, you know, the way we set it up is we'll have accounting go through and again, sort of provide a really good report that shows, you know, here are all of our subscriptions. Subscriptions is a big one where companies forget that they're paying for something that they don't need to pay for, or thinking about number of users. So a lot of subscriptions, you pay by the number of users. If you haven't updated your user count, you're probably paying for unnecessary seats for that subscription. So really just kind of looking at expenses by vendor. I would say something else that I think is really important to understand in terms of thinking about, you know, a dollar of revenue, dollar of profit and cash flow is really looking at your expenses into what is fixed. So good examples, like what am I paying for rent every month for office space, right? What is variable? So that should really be your cost of goods sold is variable. So
commissions, things like that
commission,
vary with revenue. Sure.
Yes. Merchant fees, right? So if you have a higher volume of sales and you're using a merchant processor, that is going to be variable, but it should be variable as a percentage of revenue, right? Or the percentage of revenue should stay consistent on that, right? Same with what you're talking about with commissions. We pay people 5%. We know that's going to be 5%. We also need to look at what's discretionary. So discretionary spend, marketing, advertising is a great example, right? So my businesses, especially my e-commerce, they're looking at their advertising spend like very thoughtfully because that's a big part of the budget, but sort of tailoring it as they go based on, are we hitting kind of our budget where we thought, because that's something that is controllable and discretionary.
Yeah, I know. I mean, another thing that I've seen happen is digital marketing expenses have gone through the roof. You know, Facebook ads, Google placement ads, all these things, the effectiveness and the cost have gone up. So you bring up a really interesting thing. How in your, when you're coming up with a budget and forecast, how does that then inform you as to what sort of key performance indicators? We talked about a bunch of them, whether it's inventory turns and we got that one throat to choke in like the warehouse manager, or whether it's, you know, how long it's taking for you to get paid in the one throat to choke, which might be your accounting manager, your controller, and your accounting and finance department. How does the budget and forecast inform you as to what you're going to want to look at on a monthly basis and as far as KPIs?
Yeah, that's a great question. I mean, we talk about a lot at TGG, defining what's the most important thing for sort of each job role. And so what you want to think about is what's the most important thing for that department and how is that measurable? So that way we can come up with sort of what's the most important KPI. And we want that to be something that is set up. That is basically that tracking that is going to help us achieve the goals that we set out in the beginning of this process. So we should really be tracking KPIs that are goal oriented, right? I think sometimes people go a little crazy with KPIs and they're like, we're looking at 25 KPIs. And it's like, well, what are the most important ones? Let's pick 7, something, right? And then make sure that those KPIs and sort of our targets are embedded within our forecast. So,
sorry, go ahead.
I was going to say, like we were just mentioning on advertising and the increase in digital marketing, really important metric, return on ad spend for, you know, especially e-commerce. What's our target return on ad spend and how are we monitoring that? Is the accounting department getting the data to the marketing and sales department that they need, right? So it's important during this budget process as well that the accounting department and the other departments work together to say, like, what do you need to manage this? And we'll make sure that you have the data in order to help you achieve this.
Right. And that's really just increasing accountability as you go, which obviously then helps with the reforecasting every quarter. So let's kind of take a little review, because I got a couple of questions in here that I want to make sure we get to. What I heard you say is, listen, start now. We're September 28th. Start now with getting your executive team, partners, board, whatever it is, together to confirm mission, values, vision of the company, that strategy, that sort of stuff. Then start really starting the budgeting process October 15th with making sure that your department heads have all the information they need so that they can forecast out what 2023 is going to look like and get it back by November 15th. And then you should have a first draft of the budget. And then basically it's budget ping pong back and forth until we finish it by December 15th. I heard you say, hey, listen, let's make sure we've got roles and responsibilities clearly defined. CFO runs the process, controller runs the spreadsheet and the modeling, all the department heads own their own budgets, and the CEO really owns the vision and the strategy of the organization. Then what's the difference between budget and forecasting? Budgeting is a set it and report against it. Forecasting updated quarterly is what I heard you say.
Yes.
Some don'ts, do not do's. Do not just set up random percentages for increases in revenue. Do not use an unrealistic budget. Don't do this on your own without a team of people so that you get buy-in from everybody and increased accountability. Don't use last year's or last month's run rate for expenses or sales. But the reason I'm slowing down here and repeating all this is because I got a great question, which is, what if you do all this stuff and you come up with a budget that doesn't make any money? Where do you go? Do you go back to sales, or do you go to the cost side? What do you do? Because that's that sort of November 15th to December 15th budget ping pong back and forth. How do you negotiate this? And what have you seen be successful, and what have you seen not work?
Yeah, great question. That's tough, right? Because we definitely don't want to have a budget for the next year where we're not profitable.
That's right. For most companies, let's say that.
For most companies, right? We've got startups, we've got situations where it might be a big investment year and you're expecting to have losses and then, have a big return on those investments the following year, of course. So, that's why we have that month of time to do some iterations. So you asked, is it revenue or is it expenses? It's both. Mm-hmm. I mean, we really have to be looking at because I said, don't be unrealistic and don't be too lean on expenses. Sure. But maybe you've got someone that technology wants to hire, and you're like, we can push that to next year, right? Like, what can we push out further? What's more discretionary? That's where I think it's really important to understand those sort of three categories of expenses: the fixed, variable with revenue, and then the discretionary spend. So one of my clients, what we've done for next year is we basically, or I guess technically we did this back in June. So back in June when we reforecasted with multiple scenarios. Yeah. So we said, because this was when we're getting really nervous about recession, and this is a professional services company. So we reforecasted basically 4 different revenue scenarios and said, okay, if we're on target, we're good. Now let's kind of decrease that by, I think we did $750,000 increments. And we kind of looked at, again, for variable costs with revenue, we knew those were going to change with volume. Yeah. Fixed would stay the same, but then what was the discretionary spend? And it was so helpful for the business owner, because we met and I basically said, here are the levers that you can pull in the event that we do have sharp revenue declines. So I think it just gives peace of mind that there's a plan in place and we know what discretionary expenses that we can drop if we do run into something where.
Yeah. I love that. I love that. What you're effectively calling, and what you're doing is stress testing the business.
Yeah.
Right. We have our base case. And then I've always suggested, you said 4, I like 3 scenarios. What's our base case? What if it goes better than we thought? What if it gets worse than we thought? And then, like you say, what are the levers that we can pull? And that's why that reforecasting is so important to me, because we have to be able to say, okay, we missed these targets, we hit these ones. We might have to adjust a little bit. We might have to let go of Johnny and we need to hire Sally, you know, whatever the situation might be. But I think what you're saying is really important, to stress test your budget. Don't let it be a standalone budget. But we still have to get at this thing. I got another reinforced comment on the costs, outside costs support. I do think it has to go and analyze everything between that November and December 15th. You got to go do a micro evaluation of the costs and make sure that everything is being utilized properly. The other thing, though, that I really think that people don't pay enough attention to is benchmarking gross profit margins. What is your business doing? If you're at a business that is not profitable after you've done your budgeting and your budget shows a lack of profit, there's a really good chance you are underselling yourself somehow. And there's a really good chance that you are under with your gross profit margin percentages. And so I would really examine pricing, and I would really examine the efficiency of the cost of goods sold, and make sure that you're benchmarking against other teams. And I think that's one of the unique things of TGG is we have so many clients. Bonnie, off the top of our heads, we can benchmark construction or e-commerce or distribution businesses,
healthcare business,
right? All these. And so you've got to make sure that you're also benchmarking. I think to me, that is, there's no business out there in the world, a business model that loses money forever. It just doesn't happen. So where is your business a little off as compared to the benchmark?
Yeah, I love that. And you and I always talk about the importance of running a business by percentages.
Yeah.
Typically what I'll do with my clients is, like in this case you're talking about, if we look at the budget and we're not making money, is we look at, is this a gross profit issue or is this an operating expense issue? And we do that by benchmarking. If our gross profit margin is right where we're benchmarked, we know it's an operating expense problem, and we've got to really hone in on that.
That's a great point. And using the percentages will really help us do that as we benchmark against an ideal business model in our budget, and where are we a little bit off. I think that's fantastic. Okay, a couple more things I want to get to here before we end this. And that is that something that goes with, I know, our TGG way budgets, which is that set it and report against it, do it once a year, is also an annual business planning calendar. And so what I'd like to, one of the questions that we got here that I want to make sure we answer is what's the role of a CPA and other outside advisors in this budget planning process? And then if you keep going kind of on an annual basis and you look at an annual business calendar, where is their role in that, and what does that look like?
Yeah, so an annual business calendar, what that's going to do is it's basically going to lay out each month sort of what are the, I like to think of it like reporting deadlines, administrative tasks that need to be done in each month of the year to make sure that, you know, everything's covered. Again, the controller should be the one sort of coming up with this and managing it. Some examples are tax filings. So when sales, there's so many taxes that we all pay, right? So getting them all straight and making sure we're not delinquent on top of everything we're paying. We don't want penalties and interest. So setting that all up. If you have sales tax, laying that out. Also having a time each year and a month you pick where you're going to review your insurance policies. So something like that's another example of what we might have in there. When are you going to have tax planning meetings with your tax CPA? That's
where I think that question was getting at.
Yes. Yeah. And so, you know, I've got some clients where there's a lot going on in the business and we want to meet, and we meet with the tax CPA every quarter. I would say more of my clients are more sort of a mid-year point and then a year-end planning point with the tax CPA, because they're really going to be your experts that are coming in and saying, you know, here's how we're interpreting Inflation Reduction Act, right? They're going to say, this is what we think specifically can help with your business. Your CFO should also be able to help, but it's really important to be on the same page with the tax CPA.
Got it. So really integrating that CPA, and again, like you said, at least semi-annually, but quarterly into the business so that they can help minimize taxes. That's really the CPA's role. What about I'm trying to think of what about an insurance advisor, for example? What's their role in the budget planning process, and how's that, you mentioned insurance in the annual business planning calendar.
Yeah.
So how does this all fit in?
Yeah, great question. I mean, insurance is insurance, depending on your business, right, can be a significant cost to the company. So involving that insurance, your insurance broker in the process of understanding how much could our insurance costs go up next year, both in terms of how much is, how much are premiums going up on a per person or per incident, whatever it is basis. And also we're planning on hiring 15 people. So what's that going to do to workers' comp, right? And
Sure.
understanding and sort of trying to get ahead of, because your policies might renew kind of on an off calendar year cycle, but making sure to involve them on what are they seeing, what can we expect in terms of cost increases.
Well, I love that, because I also think insurance is one of those, if I go back to that person's question before, if you do a cost analysis, insurance is one of these places where you might be able to offload risk and really reduce cost. And not so much on health insurance and benefits, but think about in terms of liability insurance. If your balance sheet can support a higher deductible, you could have lower premiums, and forecasting that in is another place to cut costs, and I think really important. Okay, we're getting here near the end. I've got a couple of other questions that I want to make sure I get to here. One of them is I'm a little confused about the annual business calendar. Do you have an example or a sample?
Yeah, we do. So we actually do have an example annual business calendar, keeping in mind this is iterative. I mean, you work with your CFO and controller to really update this as you need for your specific business. You'll see we have sales tax filings on here. If you're a professional services company, that doesn't apply to you, but you're going to have other things that do. So we're going to provide this to all of our attendees complimentary for attending the webinar for you to reference. And I do want to say, I don't think I covered this, but this is really important because this can help. I talked about valuation earlier, right? This can help with valuation because I've been through several M&A transactions with my clients, and during due diligence, a lot of what they ask for are things that are covered here on this annual business planning calendar. Same with looking to get a loan during the underwriting process. So it's just nice to have this in place. It's one less thing to worry about when it's something that we have and we're tracking against.
Got it. Yeah, that's nice to have a visual with this. So Bonnie, what you're saying is we're going to get this out to everybody. I just want to make sure I heard you right. We're going to get this out to everybody at the end of this that was an attendee here today.
Yes.
So they've got a sample. Okay. But it is very dependent on their business. I'm sure there are things like I saw 940s and 941s on there, and distributions for payroll, for income tax and stuff like that. That's going to be for everybody. But there are unique things to businesses that they want to make sure, like vendor selection. You want to make sure you're reviewing your vendors on an annual basis at least, right? You want to make sure you're thinking about leases and reviewing your leases on at least an annual basis for what might be in the lease increases. We've talked about this a lot, but this is another trap that I see people getting into, is some people have leases that are CPI based increases.
I know.
And if you've got a CPI based increase, you'd be staring at a 10% increase in your rent at the renewal, as opposed to what you used to get, which was at 2%. So I think it's very important to review all these things and put them on a calendar so you don't forget them. Yeah,
absolutely. And again, you can make this as detailed as you want. You could layer something else. I think is good is you might want to put in commission payouts. Let's say you pay out commissions quarterly. You want to put those on any bonus payouts. It can be as detailed as you want. And again, very important that your controller is owning this. Obviously, get the sign off from other people that are involved in the business, but make sure that they kind of take ownership, since a theme today has really been accountability.
Yeah, I just saw an interesting question pop up here. Is do you have a similar budget development calendar as you do to this annual business planning calendar? And I think the answer is yes, it's built into that October 15th, November 15th, December 15th, but also you're going to want to see that on your annual business planning calendar.
Yeah, absolutely. And remembering CFO is really in charge of making sure that we're hitting those timelines.
Sure. I've got another kind of unique question here that I want to throw up. Sorry, I'm looking at this here. Okay. What role do sort of taxes play in this budgeting process?
Ooh, good question. So a lot of my, I'll say a lot of the businesses that I work with are some sort of flow through entity. So they're not taxed at the corporate level, but it flows through to the owners. So,
S-corps, LLCs, stuff like that.
Yeah, thank you. Yeah, partnership, S-corp. lot of S corps. And you know, when you're thinking about that, and even with corporations, right, you really want to be thinking about what's my tax liability going to be? What are my estimated tax payments that are going to be due? Because again, that's something that's going to show up on your balance sheet as a cash outlay. It's not going to be on the income statement. So we want to be thinking and this is where the tax CPA can be really helpful. What are our estimated tax payments, and sending them the reforecast, right? So that they can see like, what are we actually expecting through the end of the year? So yeah, so taxes play a part because, you know, our profit ultimately is going to determine how much tax we're paying. And then based on whether or not it's flowing through to you as an individual, we'll want to plan distributions for that. And if the company's paying for it, then, you know, and it's a C Corp, then we know the corporate tax rate, and it's pretty easy to project.
Yeah. One of the things, at least for LLCs, S corps, and partnerships, that I see being a big mistake that people don't do often is when they're forecasting or budgeting their balance sheet and actually projecting that out as well as an income statement, they're forgetting to put in those tax distributions, which are not on the normal quarter basis. They're on the IRS quarters. Right. And so you got to make sure that as an owner, you're getting those distributions so you can at least pay your tax. And one of our best practices is take the tax rate, whatever your estimated tax rate is, and make sure you're accruing for those as you go along so that you don't have a cash flow problem. Because I've seen that often. Yes. And in fact, about 12 years ago, got myself in that problem as we had a growing business. And I'm like, this is great. I got cash. Let's go hire more people. And then all of a sudden my CPA said, hey, wait a minute. You owe a lot of money in tax. And I said, well, that's not good. I just used that money to hire a bunch of people.
Yep.
And I got behind the 8 ball on it. So it was a good lesson for me in 2 things that you said earlier. 1, meet with your CPA at least semi-annually, if not quarterly. And 2, make sure that you put those distributions into your budget so that you are ready on the balance sheet for that. All right, Bonnie, we are coming to the end of this. I saw one comment in there that was very personal to you, so I want to again congratulate you on your upcoming marriage.
Thank you.
Yes, I'll just call out Scott's first name. Scott says the ring looks amazing.
Oh, thank you. Thank you.
So we're all very happy for you in this new phase of your life. I want to throw out a couple of reminders here to everybody. There's a screen on there that's up right now. Again, we are offering this 30-minute consultation with a TGG expert. The best way to do this is to provide us with your financials. If you send us your email, we'll get you the formatting for that. We can take a look at it. We'll dive in on an accounting standpoint. We'll look at business opportunities. We'll look at things that are going on in the economy. We'll look at whether or not what you're doing with your business aligns with your vision and goals. And we'll be happy to help you in any way we can. So excited to do that. And I'm going to give one little bonus because I got one last question here. One last question, which is what's going to happen? What are some immediate things that are in that sort of tax realm that you can do to take advantage of, take advantage of the tax law and make more money for your business? And I'm going to give 3. Okay. Bonnie, just as a last thing here. The first one is this new Biden tax law that was just passed about a month ago. Gives a ton of credits for retrofitting buildings, putting solar in, installing more energy efficient systems, etc. If you own a building, this is a great time for you to think about going out and investing in some of these things because you've got the bonus depreciation that is starting to fall off next year. You have it still in 2022. So think about that between now and year end. The second thing that I think you want to think about in line with that is the SBA program. The 504 program is still a great program to buy businesses. Yes, interest rates have gone up a ton, but the SBA 504 program is still only requiring 5% down. So as real estate prices start to do this and rents start to do this, it makes it even a better time to think about buying your own building, retrofitting it with some of those tax credits, getting all of these things all at once. And the third thing that I want to really talk about is R&D tax credits. This is something that if you've got any questions about any one of these 3 things, please email us. We're happy to help. We work with these things all the time and facilitate with experts in those areas. But nearly every single business that's on this Zoom today will qualify for an R&D tax credit of some sort. And a tax credit is a dollar-for-dollar reduction in tax. And I'm going to say it the same way that the person who put this into our question earlier is going to say, every dollar you don't pay a tax is a dollar that is directly in your pocket. is very different from a dollar that you sell, which has to go through all the layers of expense to become a dollar of profit. So again, Bonnie, I want to thank you. I want to thank everybody for joining us again. Great session today, and we'll hope to see you all next time. Thanks again, Bonnie.
Thanks so much, Matt. Good to see you.
Good to see you too. Bye-bye.